All right, good morning, everybody. Thank you for coming out today for a meeting to discuss the proxy voting guidelines. I'd just like to acknowledge that this meeting is being run in under the, or rather in compliance with the open meetings law. As you may note around the room, there are actually members of the public that have joined us today for these proceedings. I'd just like to note that for today's meeting, I'm John Dorsa. I sit on as the controls rep on the proxy committee for the teachers' retirement system. I just want to note for the record that while the controller is a member of 3 of the other 4 retirement systems, for purposes of today's meeting, will be functioning as a trustee of the teachers' proxy committee. I'd like to note that there are multiple retirement systems in the room today that are all participating at this meeting. I'd also like to acknowledge that the mayor's rep, John Adler, is actually the one who suggested that for purposes of discussing the proxy voting guidelines that we have a room full of multiple systems as these guidelines pertain to each and every one of the systems.
Blame me.
We'd also like to note.
I thank you. Actually.
Yeah, we'd also like to note the proxy committees are all autonomous to each of the retirement systems, and this is in no way an attempt at anything more than just getting business done. So at this time, I'd like that if there's no objections, I'm just going to help facilitate this meeting along. And just ask that the systems identify themselves for purposes of our meeting notes and acknowledging that people are here. And I'll just go around by room. I'll ask the trustees to identify themselves, and after the trustees have identified themselves, I'll ask that the staff from the systems also identify themselves, and then we can move forward from there. So I'll begin with NYSERS. If the members of the NYSERS proxy committee would identify themselves, we could start with the chair of NYSERS.
Yeah, John Adler.
And
Ray Santander, District Council 37.
Larry Schimmel, representing Public Advocate Tish James.
thank you. If the members of the TRS proxy committee could acknowledge themselves. John Dorsa from the Controller's Office. If there's any staff from the
Valerie Budzik, Council's Office, Teachers Retirement System.
Susan's staff.
yes, and we understand that Ms. March cannot join us today, but has asked that she get a full briefing from the TRF staff that are here today. The Police Pension Fund.
Lou Turco, Lieutenant's Benevolent Association.
And Tony Rodriguez, Finance Commissioner.
And we'd like to note for the record that Joe Alejandro from the PBA has indicated that he'll be joining us mid-presentation. The Fire Pension Fund, Fire Department Pension Fund.
James McGowan, Uniform Fire Officers Association, Fire Department Pension Fund.
John Farina, Uniform Fire Officers Association, Fire Department Pension Fund.
And Tony Rodriguez, Finance Commissioner.
Thank you. The Board of Education Retirement System.
Michael Sohn, representing Ray Orlando, Department of Education.
Thank you. And we'd also like to note that.
Sandy Rich, Executive Director, New York City PERS.
Thank you.
Thanks, John.
So, with that said, I'd like to just thank you all for coming this morning, and hopefully this will reinforce the partnership that the proxy voting unit has with the proxy committees, and enhance the sense of partnership that we've built throughout the years, and hopefully this version of the guidelines will be an indication of that partnership. So at this time, I'm going to turn it over to Mike Garland, the Assistant Controller for Corporate Governance, to walk us through the guidelines and however you'd like to proceed.
Great, thank you, John. And I did just want to, there's a number of
Controller's Office staff member, I specifically just want to make sure Scott Drazel and Millicent Budai, who are part of the corporate governance team and helped to put together the guidelines. In a minute, I'm going to turn it over to Scott to walk through the guidelines. I just want to make a few framing comments. First, this is not a meeting to take any action. It's just an ad hoc discussion to brief you and to provide you the opportunity to give feedback on what is really a comprehensive overhaul of the proxy voting guidelines. The office indicated in recent years that it was our intent to do a revision, a major revision of the guidelines, but we had difficulty getting it. We finally hired a new person, and before giving him any other work, we prioritized this. And then coming out of the Funston report, it's worth noting that their principal finding on our program was that the existing guidelines were cumbersome, overly granular, and lack overall statement of philosophy and purpose. And we believe that the revised guidelines very much are responsive to that and really set out a framework. And I think to put the guidelines in context, New York City has a very long history of leadership, and I know when we get together, typically, and I've never been together with all the proxy committees at once, we often talk about the initiatives, shareholder proposals, the engagement work. But there's a tremendous amount of work that goes on in this office daily voting proxies. Just in the US, it's 3,500 companies or so a year. And so the guidelines are the roadmap that Millie's team uses to vote proxies. And New York City was one of the first to really take back voting authority from the investment managers. You've had guidelines in place since 1987. And they've been updated annually, so the existing guidelines are not necessarily out of date per se, but they were developed each year as a new shareholder proposal was introduced into the world. A guideline was written, really an instruction on that specific proposal. And it was very much shareholder proposal oriented rather than developing over, what are the issues that we vote every day. Shareholder proposals, as you'll see, are a minority of what we look at. And I think there was no roadmap for how to do it, and so over the years the guidelines built up with these very specific, granular guidelines. And I think today, if you were going to do guidelines, you'd start with what's our view of the world, and you'd filter down and establish a set of guidelines and principles that would inform everything that we do. It's clear because of this tremendous history, we can infer the philosophy of the funds. You see that throughout the existing guidelines, and what we've really done is tried to now distill that down. I don't think the expectation is that the actual votes will change much, if at all, and to the extent that they change, I think it will be improvements. So a couple goals of this process. We want to in addition, minimize and hopefully eliminate any split guidelines between the funds. We recognize each fund's separate if that's not possible, but they're minimal to begin with, so I don't think that's a significant issue. And then when we launched this effort, there was a very clear message from the trustees about a transparent process, so you could see the old guidelines, the new ones, and how we got there. And I want to commend Scott and the team for doing a tremendous amount of work to make sure not only that we have a really good set of draft guidelines for you to review, but in your book you have a map, an outline that maps you from the old to the new. And so there's been a major effort. Millie is probably the most familiar with the existing guidelines, and her staff use them every day. Scott did the lion's share of the drafting. So I'm going to turn it over to Scott, and our objective is to get input so that when we come to you formally in the spring, we have a smooth process to approve the final guidelines. And I should point out that guidelines are dynamic. We'll come back every year for updates, revisions, either on existing issues or new issues. But I think this is an important step. So with that, I will just turn it over to Scott.
Great. Good morning, everybody. Good morning. I'm Scott Drazel. It's really pleased to have you all in attendance this morning. We've been looking forward to the opportunity to present to you the direction that we'd like to take the guidelines, and look forward to any feedback and comments. So what I'd like to do just to kick us off is go over a little bit of the agenda for today's discussion, and then present some background information. And then after the presentation, I think open it up for for some of the comments on the draft. So the agenda, we recognize that a lot of folks have been trustees and active with the New York City funds for a long time and are very familiar with the proxy voting procedures and the policy. Some folks are a little bit newer to the policy, so I want to start off by just giving some very baseline data to make sure we're all on the same page of why we vote proxies and what topics we're typically weighing in on proxy votes on behalf of the funds. I'll go a little bit deeper into our rationale, taking off from what Mike introduced on why we're considering a refreshment to the policy. I'll highlight some of the guiding principles that we've tried to infuse throughout the draft revision. We'd like to then also particularly discuss a few issues that New York City funds have always been at the vanguard on corporate governance initiatives. We have a proud history and tradition of that. And I think we're positioned to, if the new policy is accepted, there are a number of issues that would keep this policy still very forward-looking and groundbreaking. And we'll conclude the presentation by giving you a sense of our timeline on next steps. After that, we'll open it up for a total free forum of comments and discussion of where you'd like to take it. So with that, I'll just jump right in. Proxy voting, why do we do it? I want to point out that the U.S. Department of Labor has repeatedly issued guidelines, most recently in October of 2015, but dating back to 1994, that the proxy vote of a pension fund is actually considered an asset of the plan itself. And therefore, fiduciary duty includes the responsibility to vote proxies on matters that might affect the value of the shares. So the Department of Labor speaks to the ERISA community and certain private sector funds, but New York City historically and other public pension funds have looked to the Department of Labor for guidance and generally adhere to the same view that our proxy votes are assets of the plan. So as Mike mentioned, the New York City funds were really at the forefront in 1987 in developing a policy of guidelines that would provide a framework for staff to analyze votes that come up for annual meetings at the companies in which the funds are invested, and to vote the proxies consistent with fiduciary duty and the interests of the beneficiaries of each of the New York City funds. So with that understanding, we wanted to highlight a little bit of what types of issues are coming up. Millicent has been with the Comptroller's Office for over 10 years. We've got a team of folks that particularly during annual meeting season, which is April through early June, are going through thousands of meetings and voting on different issues, interpreting the guidelines and implementing them to cast votes. So here's a quick view of what we're voting on. I can point out that in last year, the New York City funds voted at almost 4,000 meetings in the U.S. alone. There are almost 7,000 additional meetings that are voted at international holdings for each of the 5 systems. Currently, those votes are being voted according to the New York City International Proxy Voting Guidelines, and they're voted by the external managers. But we at the Comptroller's Office are voting the U.S. fund votes according to this policy that we're discussing today. The typical items that come up on a proxy, the top part of this chart, you're seeing what the board is presenting on proxies. And of those 3,700 meetings, at almost 3,300 meetings, director elections come up. So the most prevalent topic are the directors who are serving us as investors at these companies. Auditors over 3,000 times. Compensation decisions, advisory vote on executive pay, by which we can cast an opinion vote, essentially, on whether or not we think the pay is in line with our interests as share owners in the company. Equity compensation plans come up about 855 times last year. that approve stock options and other restricted grant programs that are paid to senior executives. Share authorizations, mergers and acquisitions, also fairly common and certainly impact or have the potential of impacting the economic value of our investments. The bottom half, you see our share owner proposals, where we all have a right, if we've held a certain number of shares, to put forward for other investors to weigh in on whether or not they approve a policy change at the company in which we're invested. There, the most prevalent are governance-related proposals that are 335 proposals came up last year. It's still a fraction of the director elections, but it's certainly the most common for share owner proposals.
And it's worth pointing out that of that 335, upwards of 70 were the New York City proposals.
So we're doing our part in prompting others to weigh in on votes. Environmental issues, of course, very common and often high profile. 56 proposals last year. Human rights, 16. Tobacco and gun safety, sometimes a lot of discussion, but less common actually on proxies, especially these days. Tobacco was a bigger topic in the 90s. Last year, tobacco-related share owner proposals, there are only 3 of them. And gun safety came up on no proxies last year, for example. Although it did come up once in the last 10 years, for example. So that's a little bit of a sense of what we're typically trying to interpret the guidelines and apply the votes. I'd like to go a little bit deeper than Mike's introduction comments on why we're looking to revise the proposal and putting forward this draft for your consideration. First, we have in the current guidelines a set of guidelines on how to vote on specific measures. We don't necessarily have in that guideline a proposed statement of purpose, or what is the vision, what are the fundamental beliefs of the systems in New York City pension funds when we are assessing corporate governance matters and casting our vote. So in the draft policy, we've tried to clarify our philosophy on governance as well as incorporate a basic description of our procedures so that companies and others might know. It has become more common in recent years for large public pension funds to publicly post their proxy voting policies so that the companies in which we're invested can say, what does this investor actually think? And who are they? How do they vote their proxies? So we thought it would be useful to include a brief description of who the city funds are, as well as our approach to voting proxies. As Mike mentioned, the current policies have been assembled historically based on what different share owner proposals or topics that have come up. That's led to somewhat granular level vote instructions. We'd like to shift, or we're proposing shifting to a more principle-based guidance that instead of necessarily speaking to how we would vote on an item that might have appeared in 1998, there would be a broader, high-level guiding approach on how we generally approach that common topic that comes up. We've also noted that the current policy was increased every year as new proposals came up. Some of the guidelines were rendered moot by regulatory reforms. So, for example, if Sarbanes-Oxley is passed in 2002, Dodd-Frank in 2010, each of those laws addressed some provisions that are in the existing guidelines, but are no longer particularly relevant because the items have been addressed. So we're proposing a more principle-based approach that is still rooted in the legacy of almost 30 years of proxy voting policy with the city funds, but will also be forward-looking so that it would provide guidance on the types of topics that typically come up. In going through the policy, we've also noted that some of the instructions are conflicting. So, for example, if we adopted a guideline in 1996 that we support boards that are 50% or majority composed of independent directors, but then in 2002 adopted a guideline saying we support boards that are comprised of 2/3 majority of independent directors, We have both guidelines, so there's a question of which is the actual position of the New York City funds. So on instances like that, we've attempted to harmonize and are proposing a harmonized approach that, for example, we endorse 2/3 majority, substantial majority of independent directors at the companies in which we're invested. There are also a number of specific guidelines where the individual systems have instructed us to vote separately. Wherever those split vote instructions occur, there's a small number of them, and we'll go deeper into this. We've tried to assess what's the real economic interest of a long-term investor like the New York City pension funds, and would it make sense, is there a path forward that might harmonize the approach of what's in share owners' best interest? And we'll cover that in closer detail. And then lastly, because we have a 30-year-old policy, it has become quite lengthy. It's over 110 pages. We think a simpler policy might provide clearer guidance for folks. So the draft policy as it exists today is down to 38 pages. There has been a heavy emphasis on shareowner proposals in the existing guidelines. As we laid out, we're typically voting on board proposals. So instead of the current guidelines that start with Cold War issues such as MX missiles and nuclear warheads, we propose a more rationalized structure that starts with the board of directors. You know, who do we want serving us as share owners, and follows the format of a typical proxy voting pattern, as well as what's prevalent on proxies, while also, of course, giving attention to the other issues that certainly matter. So what you have in front of you in the draft materials that were circulated includes, as a proposed structure, of a basic one-page description of who the New York City funds are. 5 separate systems. NYSERS is one and prominent among them. Sometimes on staff, companies in which we're invested will refer to NYSERS commonly. We want a statement that clarifies that there are 5 systems that, in fact, are that we're voting proxies on behalf of. We've included a basic summary of the purpose of the policy and principles for your consideration, and a very brief description of how we vote proxies. So there are 5 different systems. Each of those boards select a proxy committee that has oversight for promulgating the proxy policy, and then the Office of the Comptroller is actually pulling the lever and casting the votes, for example. So the real rationale here is if a company looks at the policy, they'll understand that relationship among the funds and the Office of the Comptroller. The investment policy statements, the IPS, remains the guiding document on the specific procedures and policy for proxy voting.
But each of the 5 systems may have different number of shares of votes, right?
That's correct. That's right. The policy itself would start with the boards, investor rights, capital authorizations and capital structure, incentives pertaining to executive compensation and equity awards, financial reporting, questions of auditor ratification, and other matters, and then environmental and social issues that typically come up and might impact our long-term value in the funds. The appendix, we are and have been long members of the Council of Institutional Investors. The current policy uses the Council's independent director definition, which is lengthy and robust, and often a useful reference point for our discussions with companies. So we're proposing continuing to incorporate the CII definition of investor independence. So let me go into what we've outlined as our principles. I think throughout that structure, we've proposed 5 core guiding principles that we believe would represent our interests as diversified long-term investors. The first is accountability. We're invested in these companies. We're not necessarily running them. But as providers of capital, we want to ensure that there are policies and procedures in place that best promote the accountability of the directors we elect to represent our interests. Investor rights, if we're providing capital and equity to these companies, we believe that share owners should have strong protections in the event of malfeasance, as well as the ability to assert our interests through various policies and procedures. Aligned interests. The directors of the companies that we elect, as well as the senior executives that are implementing the business strategy, we'd like to ensure that their incentives are aligned with our incentives as the providers of capital. Transparency. A fundamental belief throughout the proposed policy that our financial markets work better when investors have clear, accurate, timely, good information about the companies in which we invest. That includes financial reporting, but it could also include information about potential environmental risks that might not present an immediate cost impact for the company, but could undermine our investment over the long term. And sustainability, much similar to that last point, companies should efficiently manage, have policies and procedures in place to identify risks that could undermine the long-term viability of the company and properly mitigate those risks over the long term. We're looking for sustainable value as long-term pension fund investors. So with those principles in mind, we've applied through a variety of sections in the policy, policies that by and large would not change the way the funds are voting if this were accepted. We've kept the policies very consistent, but we do want to highlight a number of areas that we think would keep New York City particularly at the vanguard of institutional investors on outlining our expectations of companies. First, for example, board independence. This policy very clearly, unequivocally states that we expect the substantial majority, at least 2/3 of the board, to be comprised of independent directors that are unaffiliated with the company. That policy would align New York City with both the Council of Institutional Investors, as well as other prominent governance organizations like Conference Board and the National Association of Corporate Directors.
Just to point out that the companies are required under the securities laws or listing standards to have a majority independence. So what we do is we're establishing a higher standard than what would be required.
Yep.
But does that mean that we'll vote against directors who are non-independent if they don't reach the 2/3 threshold?
Sure. So the policy would.
Repeat that, John? I didn't hear you say.
My question is, if a board puts forth a slate of directors where less than 2/3 are independent, will we vote against either the whole slate or those directors who are non-independent, who bring the thing below 2/3?
Sure. So the policy would state that generally, when a company presents a board for our approval that is not comprised of 2/3 independent directors that accord with the Council of Institutional Investors definition, we would withhold our support or vote against the unaffiliated, the non-independent directors that are being put forward for a vote. In our assessment of the impact of that, at this point in the marketplace in the U.S., the vast majority of boards are independent. Typically, the CEO serves on the board, but beyond the CEO, it's fairly rare for there to be an additional non-independent board director. On occasion, if for succession planning, a company might appoint to the board the next in line to be CEO to the board a year or two in advance, so that person is kind of coming up to speed a bit. But beyond that, it's not common. So this would both be in line with not only other governance outfits, but also really market practice at this point.
Can I ask a related question? I'm sorry.
One of the things we also do is that there's a committee that the nominating committee is responsible for appointing these independent directors. And in cases where the board is less than 2/3 independent, we hold the members of the nominating committee responsible by voting against them.
And related question, many companies have the CEO serve as chair. And I know that you guys helped spearhead, I believe, the effort on Jamie Dimon.
We have a very black and white view of the world that all boards should be chaired by an independent director. There are some shareholders out there who are comfortable with a strong, quote, lead independent director. So we will always support a proposal for an independent chair. We would only take action against a board if it was, remind me, if it's not 3/4? Is there a guy?
So the proposed policy would be very unequivocal that the funds endorse an independent director. So we'll always support that. For boards that don't have an independent director, there's no action to withhold support. With it in the U.S., it's a very mixed market. Maybe, Millicent, correct me if I'm wrong, maybe about 50-50. So given the prominence of non-independent chairs in the U.S., if we were to consider an impact on voting, that could have a greater impact on the fund support.
Yeah, and actually, people often refer to it as split chair CEO, which is actually not, it's sort of shorthand, but you can have a chairman who's not the CEO, but who's an insider, either because he does business with the company, he's a former executive. So it isn't just that we want those roles split, we want the chairman to be independent. And I think that the prevalence of independent chairs in the marketplace is fairly low. I think it's probably less than a quarter.
So, in other words, if the company nominates the CEO to be chair, and he or she is the incumbent chair, we don't necessarily vote against that nomination.
No. Well, we don't have an opportunity. So, no. You don't, and we don't vote on whether they're, you don't vote on someone as chair. You just vote on directors. It's up to the board who they want to make chair, and if they happen to have elevated a chairman who's not independent, that in and of itself doesn't prompt action against the board. But we would always support an effort to let a shareholder through an independent chair.
So let me just make sure I have the, independent is no connection to any of the other board officers or any inside the corporation.
No family or financial ties, and this is what Scott referenced, the CII definition of independence, which is much more robust than the listing standards on the stock exchanges, which have, I think, a 3 or 5 year look back. I think we basically, if you've ever had any financial or family tie to the company, its executives, we wouldn't consider you independent.
It's a 5 year look back as a CII.
It's CII.
And on the flip side of John's question, so we have an independent officer, board officer, we'll vote against them if they don't meet certain other criteria that we like.
The overall board.
The director
So
definitions.
not believe in any of these other issues or we vote against them.
Yes.
Right, there's a host of reviews for any director nominee, including performance. Does the director show up to meetings to serve us? Has the board performed in our interests over the long term? Are they on more than 3 other outside boards? Are they overcommitted to actually have enough hours to serve our interests, for example? So this would be one consideration among a number of factors for reviewing.
And some of those are objective, how many boards they sit on, but we also try and you don't really have a window into the boardroom and to know which directors are adding more value than others, but we do look at the performance of the company and overall board and then look at committee assignments. So if there's a history of granting excessive compensation, we would withhold support or vote against members of the compensation committee. If there are significant audit failures, we would, or risk oversight failures, it would be the audit committee or whatever committee was delegated to risk. And so there's a fairly articulated guideline in here around directors that you know, it lays out some principles and then lays out some specific examples. But essentially, in the event of board or committee failure, in our view, that would prompt a vote.
So what are the subjectives?
Compensation, audit.
There's also, we look at within those guidelines whether or not the performance of the committee, whether or not the directors serving on a specific committee have fulfilled their duties in carrying out the charter of that committee. So for example, if the company is engaged in excessively risky financial behavior, and it's the charge of the audit committee, or if there's a separately constituted risk committee, the draft guideline would position the funds to be able to assess the recent track record of that committee and oppose any incumbent director who's been put forward for the fund's consideration on that committee. So for example, in the financial crisis, where there's a lot of concern that large financial services companies fail to properly exercise oversight for risk on the company, the draft policy would continue the recent policy of the funds, that we would be in a position to oppose the incumbent nominees who failed to fulfill that charge of their committee to monitor for excessive risk.
So it seems like there's some objective and subjective melding there. That's what I'm trying to figure out.
That's
So
right.
So the objective are like performance, things of that nature, that making sure the company is operating correctly, making sure that they're showing up to work, making sure that they're doing the right things. But the subjective are things that we get a little dicey, so I'm just a little more concerned as to what the subjective are. So for example, we have independent directors and board officers. Maybe that board is not racially diverse. Are we going to potentially target that board? I'm not saying that's the overriding factor, but is that something that we're going to consider in order to vote against some directors, things of that nature? Or if they're not supporting certain issues that we are find important, whether it's diversity, sexual orientation, making sure that they're supporting those things, we will vote against a particular director to make sure that the board reflects what we want.
Sure. So the draft policy, in line with the existing guidelines, has both instructions on where we can oppose incumbent directors, as well as guidance on aspirational practices that we consider best practice in our interest as institutional investors. So for example, on the independent board chair example that John raised, we believe in the long term it's better for us as long-term investors for an independent director to exercise oversight of the board and management. That it's a fundamental conflict of interest for the chair of the board to also be the chief executive. You can't monitor yourself, for example. So we would support shareowner proposals or any moves for companies to ensure that the chair of the board is fully independent. But there is no instruction in the draft policy nor an existing policy that would dictate that we would oppose a CEO who also serves as a chair who's been put forward for nomination. Similarly, this is possibly a good segue for consideration on board diversity. The policy, in line with kind of practice and the existing policy, is consistent with empirical research that's found that boards with a greater diversity of skills and expertise, competencies, geographic background, racial, gender composition, tend to better deliver performance over the long term. So that's an aspirational expectation that we encourage all boards to ensure that there are diverse attributes on the board that are aligned with the business objectives of the company. They're kind of best positioned to oversee the company's strategy for long-term value creation. We do not have, within the draft policy or in the existing policy, any prescription for us to withhold support from a board that we might deem inadequately diverse. So a board that, for example, a large cap company, I think it's only about 17 or 18% of the large cap companies that have absolutely no women at all serving on the board. There it's certainly the expectation of the funds, and it's been aligned with a lot of the work and the initiatives to engage those companies and encourage them to constitute a more diverse board. But there's not to be clear, there's in the current draft policy, there's not a guidance for us to oppose.
Let me just speak one other issue here, which is a challenge for us, because we're trying to figure out how to be more aggressive on board diversity, and that's actually why the proxy access proposals were filed at companies that we identified as laggards, because if the company doesn't solve the problem, investors would have the right. One of the real challenges is we don't really know. We have no idea the makeup of a board unless you go through and look at names. That's how people figure out gender, or pictures if they have them. Racial diversity is far more challenging. And if you have 3,500 companies, the controller with a bunch of other elected fiduciaries last March actually sent a petition into the SEC seeking a requirement that all companies provide a matrix of their board that not only shows the skills and experience of each director, what they add value to in the boardroom, but also identifies their gender and their race and ethnicity, almost like an EEO-1 report, because right now shareholders don't easily have that information. Stepping back a little bit more to because I understand your point about guidelines around subjective analysis. When we changed the director election guidelines several years ago, one of the things we did is we brought in an additional proxy advisor. So now we buy research from both Glass Lewis and ISS in order to help us with that analysis, as well as we have other vendors as well, but they're not as directly focused on helping us to apply our own guideline around directors. And it was really the director elections that led us to get more research so we can do that analysis.
So, a question about that. You said that there's no policy that I guess de facto would allow the vote against on directors based on board diversity. But if there was a pattern of discrimination or lawsuits by board members or anything of the company, there was enough leeway within the guidelines to take specific action against directors at that board.
It's a good point. Within, for example, on a typical board, the audit committee is charged with compliance oversight, and if the company does have a history of non-compliance on a matter such as equal employment opportunity, that rises to the occasion of kind of a particularly egregious concern, repeated pattern, that could position the funds to oppose incumbent directors for having failed to fulfill that duty of the Charter's fair plan. So with your permission, I might just kind of go through a few of these other topics, highlight some areas of the split votes, and then give a sense of the timeline, and then we can open it up for broad kind of questions and feedback or any other clarifications.
Yeah, and we can come back to this discussion then, if you'd like.
Okay, so on board diversity, we did want to point out that we've tried to include a robust statement at the beginning of the directors section on what constitutes diversity, that the systems do define diversity very broadly to include job experience, skills, expertise, competencies, geography, age, gender, race, sexual orientation, and gender identity, among other factors that the company might consider in considering what constitutes the board that's best positioned to exercise a long-term oversight of the board's business objectives. Environmental guidelines, very strong support for energy efficiency, responsible water stewardship, which is increasingly a very key focus for in the markets, and an expectation that companies mitigate climate risk, which has long been the position of the funds, and I think will be heightened after the Paris Agreement last December. Labor rights, Our policy is perhaps unique in having a very unequivocal, strong endorsement of the International Labor Organization principles. That includes the expectation that companies respect freedom of association, workplace safety and health, and of course equal employment opportunity. And in the specific guidelines on equal employment opportunity, we've included the rich history of the funds on working on the Sullivan principles in South Africa, as well as the McBride principles in Northern Ireland. Human rights, the guidelines expect companies to have strong standards applied throughout their global operations, including their supply chain, and to monitor and report out on their compliance with those standards. Labor rights for us, I think, go beyond simply adhering to compliance with labor law and international labor standards. We, in the policy, recognizes that the workforce plays a huge role for any company to actually deliver long-term returns. So we try to recognize the workforce as a valuable driver in the company's success and expect companies to align compensation and benefits, appropriate retention rates, training and development, and other factors that could promote the long-term viability of the company. As Mike has reported to the committees in the past, the funds have been active with a coalition of institutional investors that are engaging more and more companies on the role of human capital in a company's business plans. Every company says workers are their most valuable asset, but rarely do we have a lot of information about that. So this policy would endorse that. And of course, strong investor rights. We want to ensure that we have legal recourse in the event of malfeasance. And in recent years, there have been a number of different new, innovative, kind of creative legal maneuvers by companies that might quell or diminish investors' position to actually seek recourse in the event of malfeasance, including mandatory arbitration provisions that popping up not just in investor law, corporate bylaws, but elsewhere in consumer bylaws, for example. The policy definitively opposes such provisions. I know it's been a topic of consideration since our fall meetings to highlight where in the existing policy there are instructions for split votes among the funds. We've highlighted the 10 areas on this slide. I think I'm happy to go into any of these areas. In the materials that we sent, we presented both the draft policy as well as the existing policy, and tab 5 of the materials has a side-by-side comparison by subject of each of the policy areas. And the beginning of the tab 5 highlights the specifics of where there are split votes. To give you a little bit of flavor, I'll just touch on 2 or 3 of them for now, and we can answer any other questions during the remainder of today's meeting. But human rights, for example, the existing guidelines have 22 separate vote instructions, all generally, I don't think anybody's surprised the New York City funds support human rights. Anybody opposed, raise your hand, perhaps. There was one guideline from 1997 pertaining to Indonesia specifically, it's not Burma, that's a mistake, that included 4 separate requests to a company. 2 of those requests were for the company to report out and disclose a social audit of its operations at a mining company in Indonesia, and to continue to report out going forward. That would be perfectly consistent with the existing policy as well as the spirit historically. The other 2 requests at this specific company requested the company to stop all operations in the area until there was a peace in this conflict zone. I think I wasn't here in 1997, I'm not sure who was, but I suspect that that's what prompted some of the funds to have a different view. Some funds might say we support the disclosure and active monitoring and compliance in an international operation, but we're reticent to tell the company to withdraw from an existing business line until there's peace. But that said, that situation in Indonesia is dated. It's from 1997. And so what we've proposed going forward is something consistent with the general thrust of those 22 guidelines. Similarly with renewables, the current guidelines only have one guideline. It's actually a split decision, but it was based on a specific share owner proposal that had a specific target of a company improving efficiency by 30%. There's no context on which industry, which company is 30% below what its peers are doing, is 30% above what its peers are doing. So we've taken that issue and we propose that we generally support companies to report out on efforts to enhance the energy efficiency of their operations and perhaps adopt their own targets and disclose to us and tell us why they're rigorous standards for going forward. Similarly on tobacco, I referenced earlier that very hot topic in the 1990s. We have 28 existing guidelines. We've seek to harmonize across those guidelines. They're generally consistent on a number of key principles, but there were 5 areas of split votes. The draft policy would recommend that companies assess the health impact of tobacco-related products, adhere to advertising standards. It's been consistent with our approach for 30 years, as well as assess the impact of advertising on consumer markets. Those 3 general frameworks would position the funds to continue to support the typical resolutions that come up when they do come up. Although we did point out that, for example, last year there were 3. Charitable contributions. We generally support disclosure of a company's charitable contributions in line with we support disclosure on political contributions. There has been a history of share owner proposals of investors saying, we want the company to invest X number of dollars in our local charity. The funds have historically been deferential to the company to decide its own charitable contributions, and the policy as proposed would continue that spirit. There was one split vote instruction that was particularly targeting tobacco companies where there was some a split sentiment among the funds. That resolution would require the company to give a charitable contribution to one specific organization. So in our review, we thought that guideline was inconsistent with the general spirit of not dictating a charitable contribution to a company. So we've addressed that by trying to harmonize. But this is for your consideration on any of these, and I'm happy to kind of go through any of the other points.
Can I ask a quick question about this? Obviously, since 1987, a long time, the SEC has routinely ruled certain things are permissible on proxy and certain are not.
Yep.
Certain issues. A lot of the issues and a lot of the split votes probably aren't issues that the SEC, at least right now, whether we like it or not, have ruled that are not permissible to be on as a proxy issue. You mentioned like guns, for instance. There were none last year, but that's because the SEC pushed off the one major one that Trinity Church tried to do. So, is this robust enough and flexible enough to entertain the possibility the SEC might change what they allow on, in terms of a ballot vote, but also, does this take away a lot of those issues that right now, it's kind of moot, as you said about Sarbanes-Oxley and others in terms of regulatory scheme, but in terms of the SEC's own rulings as to what's permissible. Because I'm not sure, would directing a shareholder to a specific donation be permissible at this juncture? Would the SEC just say it's it's business judgment and therefore would not be subject to being put on the ballot? So I just, as long as we're looking at these and there's so many different votes.
Yeah, I think it's an excellent question. The SEC would allow a share owner proposal as long as it kind of has the minimum investment and fits along the other criteria to be placed on a ballot that could tell a company to we want you to stop this business line or to disclose to my Uncle Fred. There are some kind of there's some permissiveness in that. However, since the 90s, I think share owner proponents, particularly institutional investors, as well as very common retail investors, have evolved how they frame specific requests, because typically if a share owner proposal is prescriptive, it gets low level of support broadly, and so it's not likely to really have much impact. So what we've seen in a number of these areas is that investor proponents are more likely to ask for more information or to ask a company to assess the risks of a certain business line and to disclose that so that the market can make an informed decision of whether or not, how this might impact the long-term viability of the company. So a lot of the guidelines are in that spirit of we want more information, we want to be able to assess the risk of to our investments, and it would be, I think it's fair to say we think that there's minimal impact on avoiding something that's overly prescriptive that we might otherwise defer to the company. I would point out that one thing that's missing from this list of 10 on the split votes is the question of guns and gun safety specifically. I've been with the Comptroller's office for about half a year now, and there's been a lot of activity among discussion around guns. But in looking through the policy, I was surprised to see that there is no split vote instruction. All funds have been consistent for a number of years in endorsing that expect companies to promote gun safety specifically in the long-term interest of investors. So that's one area where there's currently a harmonized approach and has positioned the funds to address the one resolution that came up, as well as perhaps be a public representation of the fund's position on the issue. So it might.
Before you go on, just to be a little helpful, right? Instead of we have tab 5, but just quickly let us know which funds are split off of the split. So I know tobacco, it seems like TRS has the majority of the splits, split vote instructions. Am I correct in that? Can you put them with tab 5?
Sure. So on. I think I might.
Roughly where, for example, my fund is on the split as opposed to TRS as opposed to.
Yep. So on tab 5, the first 2 pages have a specific page number reference. I don't have on hand which funds split off, so that I wouldn't need to. We could look at that if you'd like it presented in a different fashion. But at the beginning of the tab on page, yeah, sure. So on page 20, for example, the question of solicitation, it was the fire department that in 2006, fire plan, had a separate position on the matter. Sure. We've endeavored to be transparent, but I appreciate the suggestion for another format. And I'm happy to kind of delve into any of those specifics on the split vote instructions. But to kind of conclude this overview, we also want to give you a sense of our timeline at this point. I know Mike has referenced that the funds have talked about a possible refreshment for a number of years. At the October proxy committee meetings of each system, the proxy committees were briefed on this project, and it was suggested that we meet collectively to provide any feedback. So we set today's date as a first ad hoc meeting of the proxy committees. We have slated a tentative date of February 26th, that pending the discussion and the review today. If the trustees find it useful, we're happy to kind of gather feedback, incorporate any changes, and come back to a meeting in a few weeks and present those changes for your consideration. That's only as necessary, so we don't want to use too much of your time if you don't want us to, but if it might be useful, we've already slated that in everybody's calendar. I think the ultimate goal is to be able to present a proposed policy for each committee's consideration at the usual spring proxy committee meetings, which I believe typically happen around April. Those dates are not yet set. So that we could expand this timeline with more meetings. we're certainly happy to be available on a one-off basis, either by email, phone, or I'm happy to meet with anybody as pertaining to policy. But this would be a little bit of a sense of the timeline kind of for going forward. So again, I really appreciate everybody's participation today and your review. We know that we killed a few trees that might not be consistent with our policy and sending out these binders, but we have attempted to be transparent with existing policy in ways that it might revise going forward, and are happy to kind of take any questions, clarifications for going forward.
So first, like one comment and then like two questions. One, first, this is excellent, and I think that what you guys showed us at the kind of our October proxy meetings is kind of a preview of what you're doing and seeing all the progress done. I think it's amazing. One of the things that the 111-page document kind of shows, it does give a good, clear history of like our process, New York as a leader over the past 30 years, and wondering if there's a mechanism to kind of retain that history, even as we get make sure that the guidelines are crisp and clear. Thinking about, and so hopefully, like with obviously the proxy access, kind of one day we won't. Hopefully there will be a law we won't need that anymore. But we still want to memorialize the fact that we were leaders in doing it. And so finding, and I don't know, it's been 30 years. Like if we have a kind of a document or celebration of the things that we've done. Whether in our kind of overarching statement,
in the
philosophy,
opening statement,
or something like that, just talking about those major milestones. But I think it's overall excellent and retaining all the hard work that you all have done. The two questions. The first, with regard to when I was looking at many of the initial kind of the actual philosophy for each, let's say, shareholder ratification or what have you. In addition to talking about the four, we also do describe the type of policy we would oppose. In those kind of in particular scenarios within the kind of larger four category, and it occurred to me that we actually do have kind of an opposition philosophy as well, and that's if we get too prescriptive, if we're kind of too down in the weeds in dictating what a company does, and whether or not in the opening statement we also kind of talk about the type of, in general, the type of proposals that we would oppose. Saying, look, our job is ultimately to dictate large, broad policy and not necessarily the things that the day-to-day kind of operations of the company. So one of you all's thoughts on that. And then the second question is on whether or not you believe to what extent these would apply to kind of guidelines for our developed market and kind of emerging market, I guess, proxy votes. I know we currently give those to the manager, but kind of over time, whether or not these would apply, or like what type of nuance we'd allow to give to them. Things like board directors where, independence, let's say Japanese companies have less independence. And so.
Let me take that. First of all, I think your first two comments speak to how we can build out the opening statement, both to capture the history and leadership, and also at a very high level, just the notion that we want to hold companies accountable, but not micromanage, and so generally support disclosure, but not overly. Some very high-level statement. I think that we can easily, both of those, easily reflect. Third comment, currently we have distinct guidelines for U.S. and non-U.S., as Scott mentioned up front. And the non-U.S. are actually very coherent because they were put together, I'm not sure when, and then because managers, to be honest, are not equipped to vote different guidelines very well. What some of your managers do, even though they're required to vote your guidelines, is they hire ISS at their expense to vote your guidelines. And ISS has helped us to update those guidelines. I don't know that they reflect the same level of sort of leadership that these do. They're very good. They kind of are applicable broadly in markets. They also have some statement that where they're silent, the spirit is informed by the domestic guidelines. I think in the near term, that's probably the right way to go. Sometime down the road, figuring out a high-level set of principles about how we think across the world may make sense. The issue you raise is a good one. So if Japanese boards are minimally independent, do we defer to local market practice, or do we believe boards should be independent, which we do, regardless of the market and market practice? And so And I actually don't know exactly how our current global guidelines, since we don't apply them on a daily basis. But I'd say the short answer is we have good global guidelines. I think a project down the road may or may not be to harmonize, and we're certainly thinking about this separately, how to bring in-house non-US, so that would still be under the existing non-US guidelines.
Thank you.
Yeah, I think they're excellent comments. And we do have a brief reference in the introduction that this largely pertains to the U.S., but as Mike said, it could provide that there are separate international, but the general spirit of this philosophy could be a foundation for how we view international.
Thank you. Appreciate that.
Sure.
I think I think over time you'll see the entire market itself. Right now, the custom is to defer to individual market practices.
Mm-hmm.
But as emerging markets and all of these markets become, more global, where U.S. all these residents, etc., buying stocks and all these companies, they themselves are evolving too and getting closer to what is considered best practices in the U.S. And so I think not just us, but over time, all of these markets will begin to evolve towards some kind of common standards.
First, I just wanted to say that Mike and Scott, your team has done a terrific job. Part of the ability for the systems to have cloud and ability to change things, as it has since '87, is to be a force on some of these top-level issues and be partners with others like Houstoners and others that have really been leaders along with New York City. So this is a great way of really reform and being more efficient. The question I have is, a lot of things here are case-by-case analysis, and clearly that's giving discretion where there's already been discretion. But sometimes there are new issues that come up. If 10 years ago, 15 years ago, someone said cybersecurity, they would say, well, what is that, right? How do we vote on that? And the question is if a new issue comes up, one that we can think of now, or maybe we can't think of because things evolve over the next year, 2 years, 5 years, is it more? Is the intent is to try to fit it in within one of the categories that exist because they're broad, or would there be opportunities to then come back to the respective proxy committees and say, there's a new issue we hadn't really considered. While it could fit into something, we'd rather have that just looked at to kind of make a decision. But it's within a philosophical approach that's similar to things. I just, is this the end all be all, or is it an evolving process?
Yeah, sure. You can speak to that.
Yeah, it's both. I think the first is when there's a genuinely new issue that is not covered here, we would be responsible for coming back to the committee to seek. We'd make a recommendation and seek guidance. But what we want to avoid is where there are issues that look, smell, and are a lot like issues that we've been voting on, but we don't have to do that every time. I mean, the existing guidelines say things like if there's a proposal that an executive should hold 60% of their stock for 2 years past retirement, and then we see a proposal that says 75% 3 years or substantial majority or substantial for 1 year, we've had to say, well, gee, is that covered by this guideline? Is it the same spirit? Where do you draw the line? And so we step back and endorse the principle around that. There is a very strong focus on disclosure, oversight, and policies, and I think generally around environmental issues, and maybe new environmental issues, that may get captured under the existing guideline. But there will be proposals, it's hard to articulate what that will be, that I think it won't be clearly covered, and then we'd have to come back. I also think we'll come back to, these will evolve even as they are.
And just to remind folks, we do meet regularly at least twice a year, the proxy committees, to discuss items. So if any of those things were to come up, I don't think that Mike and his team would be shy about kind of cutting it off at the pass to say, hey, this is the next slew of things coming on the horizon.
Yeah, it doesn't replace the spring meetings. Those are still defined within policy, and I think useful, both for addressing potential issues that might come up, but as well as this is if adopted, it's a significant rewrite of everything, and as we apply it through the proxy season, we might find a word or two that we think it's in the fund's interest to tweak. So perhaps we'd come back to the committees and suggest some refinements in the policy as well.
Do you anticipate this being relevant in another 40 years?
last time was looked at, or will this was looked at? 10 years.
Someone
You know, our hope is that this positions the funds to be forward-looking, but with coupled with a process of regular review and updates through the spring proxy committees, it will, of course, continue to evolve in time as well.
The first one was on a typewriter.
One big change like there is now.
Sure. There could be a project if we seek to combine the domestic and the global, for example. That might be an additional initiative in the near term. Yeah.
Just one question with regards to executive compensation guideline. Do you examine the metric of the ratio of the salary of the CEO to the lowest paid worker? I don't know if you, some companies impose that on themselves. Like for example, Whole Foods, it's 40, that the average of all the CEO cannot have, CEO's
Right.
salary is not more than 40 times the average salary of all workers. Is that something you look at? Is that
So
something?
we don't, because we don't know that specific ratio, but the SEC has just enacted a rule that we long and strongly supported and used to support it on a company-by-company basis, that companies are going to be required to disclose the ratio of CEO pay to the median worker, and how, and companies have not yet are not yet required to provide that disclosure. How we integrate that into our voting approach, I think, has yet to be. I mean, we certainly support the disclosure of the ratio, and I think it plays into how we think about human capital.
So the draft policy would address it in two areas. One is we have a right in the U.S. market to cast an advisory vote on executive pay. To assess our vote and our position on that, we look at a whole range of issues, including the alignment of pay with performance, the extent of any egregious pay practices, such as a significant golden parachute, the quality of the pay disclosures. But in the draft policy is also any particularly unusual disparity between the top CEO and other senior executives, or the CEO, and in anticipation of this disclosure, the workforce. So since the information is not widely available yet in the market, it's actually, I think, on one hand that companies have disclosed. That would position us to help inform possibly the pay vote. The other area that it's in the draft guidelines is that we do encourage disclosure on pay disparities. So we have historically supported shareowner proposals requesting such analysis and disclosure to shareowners.
Do you think it might make sense to explicitly state as something, a metric to examine when considering executive compensation? I mean, I noticed that you do have something where you look at the highest paid and the second highest paid, but if they're both highly paid or overly compensated, that doesn't capture, you know what I mean?
Well, I'd say we have very well articulated guidelines around executive compensation. So the fact that the ratio of the highest to the next highest is merely a way of looking at it's one metric, window into succession planning. But I think you're asking a separate question about the workforce, and
exactly right. It's linking the two of them.
Yeah, I don't think that the notion of fixing a specific ratio.
Well, I'm not suggesting fixing, but just to say that as part of the guideline, we would consider that whatever that ratio is.
So you're correct that in the assessment on the SAN pay vote, it does speak to the disparity, which in my mind was more universal. But I think it's a useful suggestion that we could perhaps consider some clarity on that provision in the draft language.
Just to be clear, are you saying that ought to be in how we vote on executive pay, that we would vote against executive pay if the ratio was?
No, not a fixed number, just that it's one of the metrics, because like you said, you look at, whether there's options for golden parachutes and, I mean, so, because it is back to objective and subjective issues, is that executive compensation is, I think, something that's somewhat subjective. People try to make it an objective process, but there's all kinds of comparisons you can make. It depends where you stand depends on where you sit, right?
Yeah.
Or so my point is only that to make it explicit that one of the metrics that we would consider is this ratio, because it kind of aligns two of the overarching policies, which is the human capital development and compensation. So it's sort of, it seems like it's an important
No,
metric.
I hear you. I think it's something I support because I think what you're getting to is a metric that goes back to like 1972, where the average CEO made only 27 or 28 times the pay worker. The only problem is I think, is it enforceable? What can we do? Nothing really. I mean, if you have a successful company, that's the shareholders are getting a lot of value, but the CEO makes 300 times what the lowest paid worker. Do we divest ourselves, or we just say, hey, you know what, that's a little excessive? How do we enforce that?
Right.
I think in the end we kind of become criticized, trying to say, the CEO is making too much money, but the company is very successful. But it's a position maybe we could put in and just say and I think they try to in some way say that pay disparity is just something that we look at.
We can look at a way to sort of incorporate the philosophy and figure it out. I do want to mention, we do take I would say, a robust look at compensation, and certainly happy to figure out. And I want to point out that we opposed that advisory vote on pay something like a third of the time across our portfolio last year. And there was a study last year that looked at the 100 most overpaid CEOs in the country and how institutional investors voted. And by a significant margin, we opposed pay at those companies more than any other public pension fund in the country, and almost more than any other institutional investor. And we got, I think it was about 55%. So, it's certainly consistent with having a view that pay ought to be aligned with performance, shouldn't be excessive. And we are going to get more disclosure on the pay ratio, and figuring out how best to integrate that and make sense of it, because some companies have more global operations. But we can try and make that a little more explicit or figure out.
Yeah, not to put a number around it, just to say that something being looked at.
Okay.
Sure. Yeah. Thank you.
It's sad to see these guys make a lot of money, go out, cause damage somewhere else, make more money, now cause more damage somewhere else, make more money. Maybe we should put out a hit list. Not that we're going to kill anybody, but a hit list of like 30 or 40 of these top CEOs that just keep moving around, causing damage wherever they go, making a ton of money. Maybe we just just target the companies. There's no way we'll be
And then they run for the Republican presidential nominee.
That's true too.
Hey, you know what?
Going bankrupt
So-
how many times? 2, 3 times?
So another, and this is a difficult one for us to track, but you asked about subjective and objective guidelines. We have provisions around problem directors. So if a director has sat on a board, if you were an Enron director is the best example, I think you've demonstrated a failure to effectively represent share owners, and we would likely vote against you at any board where you were up for election.
John Arnold.
He wasn't a director.
Valerie?
On reporting, I see in the draft guidelines, you talk about periodic reports to the proxy committees. Could you flesh that out a little more?
On the actual...
Except in the draft guidelines, it talks about just periodic reporting, so I'm trying to understand what that is.
Yeah, that's a really good, so that's language that I think is pre-existing, and I think the proxy committee members ought to have information on our actual proxy votes. That how we, and I think in part of the project, we're looking at voting platforms, and how do we get better information to the boards? Because I know at one point in history we just gave a printout, and if we were to give you a year's proxy votes, it's a stack like this. And so more recently we started to give very macro data. We vote against directors this % of the time. There's 1 or 2 tables in that postseason report. I think and we're open to input, but part of it's a technological question. How do, what's between the ultimate very high level and the granular level, what kind of information is useful? We certainly are think it's appropriate to share voting information. So we actually had a meeting yesterday with Broadridge, which is our current voting platform, to better understand the analytical tools and reporting tools on that platform. We're also looking at other platforms that may have more powerful tools. So we certainly can provide today a complete list of the votes if the boards want them. It's certainly it's your information, and we provide them when we're foiled. Yeah, so give us some guidance, but
just one. You get an let me just say this. You get an let me just say this. You get an Excel sheet or some sort of database that tells you this is how we voted this week, right? And you I assume will have a database or Excel sheet for next week, right? Let's just say. So you'd be able to send that out to the trustees and let them know, look, this is what we're planning to vote on next week. And I guess it would be up to each trustee whether to question anything or what.
Well,
I always feel you always do better with giving as much information possible, and then everybody can decide what they want to do with that.
So I would find the weekly reporting of historical and prospective votes an overly burdensome requirement.
Just throwing it out there.
But right now it's annual. We could do it quarterly. It'd be retrospective. I want to caution, careful what you wish for, but you can sit in your email. The annual list, I guess one fund's votes might be big enough to email, but we just downloaded. These files are actually too large to email often because we get foils for them, and I have to put them onto a disk. So we want to be I think ultimately they ought to be disclosed publicly. That's a discussion we can have with the boards, but we're happy to provide it on a periodic, reasonable basis in whatever format. I mean, very, very detailed.
Obviously, it sounds like there's a stagnant report, but is this information as a database that you could just provide password protected to the trustees who want to just go in and put a name? I mean, I'm not suggesting that's a solution, but if I wanted to put in tobacco and see what were the votes on tobacco, as opposed to you having to
No, I think that would be like providing people. I don't know that you have access to the State Street. I mean, the only people who have access to the voting platform right now there's 6 or 7 people on the governance team, but we would be happy to generate any report upon request. Even our custodian doesn't have access to it because of.
And I think some of the intention of our biannual meetings is to give the trustees a roadmap of where we're going as far as what the topics are, what the companies we've identified, and all of those things, kind of the roadmap at that first meeting. And then that second meeting of the year is to tell you the progress on whether or not we accomplished, what we accomplished as far as engagements. I think in the between time, the proxy unit, I think, has done a very good job of notifying the boards where there's a vote that may not fit in with the guidelines or wasn't pre-approved in the first meeting, and sends out their notice to the proxy committees that this is what they plan on doing. I know that there are trustees that have asked for additional information in the past on specific items, and they've been very happy to provide those to folks as necessary. But that in between time, I don't know how useful the actual physical votes are when we've already had the meeting that's identified what the issues are and what the target list of engagements is, and then what the back end is. So I don't know what's on those lists.
One thing, would it be helpful to give you the fiscal 2015 votes one time so that people, you get a window in, and because we can do that.
I think you got to get a sense as to what the actual information looks like, and then people can determine what they don't like, if they don't want that, or if they want to maybe do a smaller report or anything like that. Like So for example, now that I have you here, and I'm one of those guys that asks for backup, I'm just gonna say, anytime you send me, like we're gonna do a vote or whatever, send me the glass rules with the or the ISS report, whatever it is, attached to the email, so I have it. I don't have to keep asking for it. That would be helpful to me. I don't know if that's helpful to anybody else. But in the meantime, I think we need to send it at least once, so they can see the 15,000 pages of documents. Determine if they want 15,000 pages, or it's too much in the iPhone folder. I don't know.
Look, I think the reason I asked about database is not that necessarily we need it or to access proprietary databases. It's to make just putting more work on your staff doesn't make sense. It's how to make information usable for
Right.
folks. You know, I think a lot of these, especially if this is adopted, where it fits squarely in a for or against, we can predict actually votes on certain things. I think it's more of the questions of case by case, where it would be helpful to see that case by case is, you know, at least our job as trustees, Proxy Committee, and then the trustees of the full board, is to make sure that the discretion being used is consistent with an overall philosophy. So in any way to kind of be able to review that and not on a week to week.
So today, I don't think that's feasible,
Right.
but I think that in the near term, with, you know, and this is a separate discussion, we'll be coming back to you on voting platforms, but we're looking at voting platforms that would allow us to integrate our voting guidelines, that's into the platform. It may be possible then for us to hit a button and pull out all the votes that were case by, I'm not sure, but it has much more reporting capability. But today, I don't know how we would do that.
But along those lines, I think it'd be far more interesting to know what the exceptions were. Because in all these guidelines, there's going to be conflicts, and you will have to prioritize guidelines perhaps randomly going forward. I mean, you may just prioritize different guidelines tomorrow that you wouldn't have prioritized last year.
So the way most systems work, they have a set of guidelines, some things are case by case, and there's discretion for staff where they think it's in the best interest of the systems on a specific situation to vote against the policy and then provide an explanation, and those are the votes that are provided to the boards. We don't have that discretion here. I think that's the way it ought to be structured, but today, we as staff don't have the ability to cast a vote inconsistent with the guideline. We would either have to abstain or come back to the committee.
So if you have a vote that agrees with one guideline and disagrees with another guideline, which is not outside the realm of possibility, the fact that you've got breakout votes that disagree, you wouldn't vote.
So I just point out on this question on reporting, the IPS also has specific language that this does not contemplate changes to. So it does require the annual reporting to the committees after the proxy season on votes and initiatives. That stays the same. There's also guidance in the IPS that on contested directory elections, as well as in this policy, the proxy committees are informed in advance of how staff has interpreted that vote, and those are the emails you typically get. That remains in this policy. Consistent also with the IPS languages, if there are issues that are not addressed in these guidelines or new issues that come up every year, the Comptroller's Office is still obligated to, and I think it's useful, to meet with the committees in the spring to consider adoptions, or with adequate notice by email if time allows on a specific proposal, the staff would present by email the intended vote for each committee's approval, explicitly approval. So that the existing guidelines would remain the same. In the draft consideration on procedures, we've attempted to kind of summarize and keep that higher level. If there's utility in adding more specifics on the draft language, we definitely are receptive to that. And I think part of this topic is also a consideration on going forward. Are the existing procedures useful, or would more visibility into the specific details of the votes, would that be useful on some type of regular basis, yearly, quarterly, whatever, to have the specific votes on items. I think, currently, as it is, Millicent, myself, Mike, are happy to answer questions on how did we vote on specific items, or to generate reports if there are questions as well.
But we're starting with, I think, so there's the annual report, there's the two meetings of the spring and this fall, correct? Or the established reporting protocol. I think teachers' guidelines have them more regular, but I suspect it's the.
Well, I'm told that
It's not clear.
at some point in history before I got here that they said, please don't send it anymore.
Stop. I appreciate how they might do that.
We used to run the reports and send them over, and I think, Alejandro, you have asked for them in the past too. And we
No,
run
I
them and
used to
send
ask
them.
for like the
Right.
backup on some of the.
No, the report and how
I don't
we
recall
vote,
I ever
yes,
got it.
I've run that report for you. In terms
Maybe
of
a
how
while
we
back.
voted over the past.
Yeah.
And, because you get the details of the meetings about items, et cetera. It's like, we go to a 3,500 domestic companies, and you're like, in most, if not all of those, so you're getting a report of over 3,000 pages.
More because each company has issues.
Yeah, exactly.
No, and that's what I'm saying,
Yeah.
they may wanna just send it once to the trustees so that they can see those who aren't familiar with it.
I believe you.
Take a look at it, and they decide if they want the report or not.
We believe you.
We'll send. You can delete the email for those of you who don't. We'll send one out because I think it'd be useful to
Because
see
I
what it
think
looks like.
everybody has access, so if you have it in Excel, or if you
It's
have it in
PDF or.
Microsoft, some database, whatever it is, you can look at it online and then decide, you know what, after 3 hours of looking at this, I don't need to have this anymore, it's fine. And I think that, then everybody can determine, you know what, maybe I don't need this whole thing, maybe I just need, companies, the tobacco companies.
Sure.
And take a look at it.
Yeah.
from their terms.
Happy to do so.
Or as we're hoping is that as we push to get enhanced reporting capabilities from the work platform, this will allow us to run more condensed reports in a more summary form that providing all the details.
We prefer to have everybody somewhat on the same page, to understand what they have and what they're going for, and then have everybody kind of pushing in different directions and not knowing what they're going to get or what they're going to look to get.
Great. Other thoughts, comments, or questions?
This is excellent.
So you guys have seen the, or if you haven't seen, the guidelines are here. Is it possible to get a sense of whether or not people think that the February 26th meeting is necessary, or if they'd just like us to bring, or rather have the proxy folks bring this to the April subcommittee meetings? I'm just trying to get a sense of the folks in the room. I'm not holding anybody to this. Obviously, we have February 26th on people's calendars.
I think we've given Mike and Scott and Millicent kind of our, opinion. I'm fine with it, just doing the April one and coming back with the comments that have already kind of been inputted, and maybe red underlining them for our purposes. I don't know if that's.
And look, and I'll offer them up while Mike's not stepped out of the room, to take questions from members of the proxy committee if there's specific issues that when you read it the second time you say, hey, I want to clarify something. But if
My perspective, I'd rather just contact me by email,
that's
let you know that I have a question, I have this thought, and I'd rather get to you rather than have everybody come back here. They could all get the questions into you, and then
great.
April, then if you bring it to the board meeting, then everybody can decide what they want to do then.
So what will happen is, and as I said at the beginning of the meeting, we're not taking any action today, but rather the individual proxy committees will adopt the guidelines, and then however each system deems it appropriate, whether the proxy committee is the right venue to approve it. If they need to go to the full boards, I'll let the boards determine that. That's out of my purview. But we plan on bringing it in April to the proxy committees. Does that sound?
Sure, and on a number of the topics that were raised, I think on the staff level, we can endeavor to do a red line suggested language as well as summarize maybe how we've sought to address and incorporate some of the feedback, and circulate that well in advance for any consideration or feedback, and then perhaps send out a final policy that would be considered for approval at the April meetings. And as referenced earlier, Joe, we're happy to email if we missed a typo. Feel free to let us know.
Procedural question, and I think that's great, well sent question. Do we have any, the timing on this, the April meeting for adoption by the Proxy Committee, if we were to deem that with this as a committee or in our case, NICERS, needed to go to the full board, is there a timing issue that you need this in place by for the spring
season? Yeah.
Proxy season?
I don't think it's going to fundamentally change our voting because it's really consistent with it cleans up things that are largely don't come up. So, Millicent, I think, we wouldn't want to let it slip in perpetuity, but it's not something that would create a problem if there was a lag.
But conceivably, we could adopt it on April 3rd as a board, as a committee, report it to the full board, and have it on the agenda for that same week, and that wouldn't slow anything.
I think that's okay.
Yeah.
Yeah,
Okay, all right.
We've been successful to this point, and only once is
Yeah, no.
that's right.
All right, thank you.
So, I guess before we close the camera, I'd just like to thank everybody for participating today. And if there's any questions, we'll be happy to answer those via email. And thank you all for coming today.
Thank you.
Thank you.